Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. With me, my good friend and special guest, Dr. Friday with Dr. Friday's tax and financial firm. She is located in Brentwood, Tennessee, and she is a tax expert when it comes to individuals and small business owners and helping you with not just filing taxes. If you got problems with the IRS, she's an enrolled agent. She can help represent you with the IRS. She's a great resource to have. In addition to for small business owners, you know, one of the things, right, payroll, all the different filings we have to do, unemployment, all that kind of stuff that you're dealing with that you have to pay for. You know, it's good to have a resource like Friday that can take care of all that kind of stuff, and you can focus on your business, which is what we all want to do, right? All right, we've got a caller, and this is Rosie. Rosie, welcome to the Retirement Report.
Hi, Hank and Dr. Friday. I have a quick question, and I think I know the answer, but I just need to verify it.
Okay.
Because I don't like the answer. I think that's right. I bought 3 pieces of property in Kingston Springs, and I sold another piece of property in Kingston Springs to help pay for those 3 pieces that are contiguous. And I was wondering, on the cost basis of the property I sold, can I deduct, or add rather, the interest I paid on my initial loan back, you know, in the day when I bought the first piece of property that I sold? Can I add the interest on the original loan to the cost basis in order to reduce my gain?
So has this just been an investment and you haven't actually taken any of that interest on your tax returns?
Well, that's why it's an investment. But when I had the loan initially, I'll have to look back, but I think I probably claimed that interest already. That's why I'm thinking I'd claim it again, because it would be double dipping.
Right, so you've got the answer in your head. You need to go back and find out. If you did not claim it, then yes, you can add it in. If you did claim it, then you've already gotten it and you're double dipping and you won't be allowed to do it. So it's really kind of straightforward. Just go back and look at your taxes if you can, if you've got copies at least.
Oh, yeah, I do.
And just find out what you're claiming, because most times investment properties, unless it was tied to your primary residence, the mortgage, you wouldn't have been able to claim it. There would have been no place to claim it unless it was rental property. If it was just land, though, most likely not rental property. So just go back and see, because sometimes people will take their primary home, get the loan, buy the other land, and then use that money, and you know what I'm saying, and they will take the interest off. But if it is an independent loan against land that wasn't being rented out, you probably did not have any place to take that interest.
Maybe I included it with my real estate or with my mortgage interest, and I wasn't supposed to.
Well, I mean, again, if you did, no, you know, we're not going to go back and do anything at this point, because you would be entitled now to that interest. So, but just don't double dip is all my suggestion would be. Okay.
Okay. So there's nothing else I could do to increase the cost basis. It's just pretty straightforward. I bought it for $29,000 and I sold it for $37,500. So it would just be.
You'd have the real estate cost, any kind of lawn maintenance or repairs that you may have had to do to the property, as well as the original cost.
No, it was just out in the woods so I could play in the creek. So,
okay.
So then I would. What form do I put all that on?
Schedule D.
Yeah, Form D.
Yep.
Okay, that's what I thought. Okay, thank you.
No problem.
All right, thanks, Rosie.
Bye.
Bye-bye.
Bye.
Okay, and we have Joe. Joe, welcome to the Retirement Report.
Yes, I have a question for you or Dr. Friday, whichever one can answer.
Yeah.
On an investment in an annuity, if you start withdrawing money out of it,
right,
you have to pay taxes on what the annuity has made or the initial investment?
What was on your initial I'm taking it's not an IRA annuity, correct?
Correct.
Okay, so then your initial investment in the annuity is basis, so that part you've already paid tax on, and it's never going to be taxed. As you start taking money out of an annuity, it depends also on how you're taking it out. If you're taking systematic withdrawals, as an example, are you taking so much a month, or have you exercised an annuitization option where you basically traded the annuity for a guaranteed income stream?
It's a guaranteed income, but so far I haven't taken anything out. But I can start taking it out any time, so
Okay.
much a month, a year, whatever.
So depending on how, so this goes to, if you take out, just let's say I'm going to go take $10,000 out as an example. Interest comes, the earnings come out first, and that is taxed at ordinary income tax rates. If, on the other hand, you were to take it, and by the way, if you take a systematic withdrawal where you say, well, send me so much a month, it's still taking out the interest first. So that's going to, again, be taxed at ordinary income tax rates. Once I've used up the interest portion, of course, and come down to the principal, then there's no longer going to be any taxes. Now, one other exception to this, if you're doing what's known as an annuitization, in other words, now I'm going to change my contract with the insurance company, and I'm going to say to them, you take my money that I've accumulated here, and you give me an income guaranteed for life. And you can, on that income guaranteed for life, you can even put like a period certain. You can say, I want an income for life, but God forbid I should die next year, at least pay it out for 10 years or 15 years or 20 years. You can elect these type of period certain annuities. There are also, depending on the type of annuity you have, there are annuities that would allow you to take that guaranteed payment and still, if there's any balance left, that would still go to your family. So it's real important to know the type of an annuity contract that you have and the different features within it. All right, having said all that, if it's annuitization, then it will prorate that money. So let's say 1/3 is interest and 2/3 is principal. Then as you're taking the money out in payments on an annuity stream, then that'd be the way you'd be taxed. 1/3 would be taxable and 2/3 would not. Okay, so, but as you can see on this one, Joe, there's a lot of variables. Okay, so to be fair, I don't expect you to kind of like read through that contract and know all these. Do you have with the agent that you worked with, your financial advisor? Do you still work with them? Where you got the annuity?
Well, I am right now, but I'm not completely satisfied with the
Give them a call.
information I'm getting, because
Okay.
annuities, as you well know, when the contracts are, a Philadelphia lawyer can't understand one of them.
Well, there you go. Well, here's what you might want to do then. Again, first 10 callers to my office. If you call my office, 615-376, we'll put the number on the screen for you. 615-376-5325. These many times I take a look at people annuities when they come in. So but in addition to investment portfolios and the rest, we look at insurance and annuity contracts, and so we can tell you, here's what you have, here's what it does, here's its, all the, and if you're looking to take income from it, we can help you determine the best way to take it from that particular annuity. And we can also, depending on if it's an older annuity, there are some newer features on some of the newer annuities that may be more attractive with regard to income. So, we can help you with all that. Doesn't cost you anything. So again, just call the office, 615-376-5325. Debbie's standing by. She'll get you information. She'll send you out a checklist of things to bring to the appointment, and she'll schedule you in to see us.
Good plan.
Okay, thank you so
All
much.
right. You have a good day, Joe. Take care.
Okay.
All right, bye. All right. We're having a lot of fun this morning. And I hope and taxes, when you're talking about taxes and financial stuff, that may not seem like fun all the time.
It is.
But this is where, fun and education come together, right? I want you to learn a lot, because what is fun is when you got more money in your pocket and you're not linking. One of the worst things, what's not fun, is at the end of the year figuring out that I had to pay more money than or I paid more money than I had to. All right? That's never fun. So join us here, because we're going to show you some ways that you can pay only the amount that you are required to pay and no more, and how to use those rules to keep that required amount at a minimum. So join us here. We're going to be right back on the Retirement Report.